Welcome to NIPFP Podcast. I'm very lucky to have Professor Michael Devereux with us. He's a very well-known voice in international tax. He is an emeritus professor at the Said Business School and is an emeritus director at the Center for Business Taxation. Very warm welcome, Professor Devereux, and lovely to have you here.
Great to be here.
So we're going to focus a lot around what's been shaping international tax policy and discussions over the last few years. But I think it's important to start at the very beginning on the question of source versus residence. A lot of times conversations on international tax are sort of framed either as source-based tax being better and others favor residence-based tax system. In your view, what do you think works better? What's a more fair system for international?
That's a big question. Let's try and unpack some of that, because I think the starting point is to try and understand what we mean by source and residence. And I think those are two quite difficult concepts, and concepts which are largely misunderstood and confused, actually. So, and I think they also mean different things to economists and lawyers. So let's start with economists. I think the way that economists think about source and residence is, in one place we have an investor who has some money he wants to invest in a project or a business, and he lives in, let's say, country A. That's the country of residence of this activity. It's where the investor lives. In country B, where he invests, all the economic activity takes place and sales takes place, and we think of that as being the source country. So I could answer your question in terms of, okay, which of those two should we be taxing? I think we should at least note that the legal definitions are really very different to that. And in the context of the term residence, we have individual companies which are legally resident themselves rather than the kind of individuals. So if we take my example, we have the investor in country A. He sets up, for example, a company in country B. That company in country B is legally resident in the country B. And so when we talk about taxing on the basis of residence, we might mean we're going to tax in country A because that's where the investor is. We might mean we're going to tax in country B because there's a company resident there. So we need to distinguish those two. Then source, I think, is equally problematic. In the economic approach, we usually think of country B as being the source country. But again, in legal terms, we're really thinking there, if there's a company in country B which is resident there but receives some income from some other country, say country C, then country C is the country of source. And so, we are unpacking your question, and I guess I have to ask you, what do we mean by, which of those definitions should we take? Or we could think across all those three countries and say, where should tax be levied? And I think I would make a further distinction as well between what we think of as source and what I think of as being destination, or origin and destination, which really comes from the kind of notion of that we have with the goods and services tax, a GST or a VAT, which is to say that, if I'm producing in, let's take some other countries, I'm producing in country X, but exporting to country Y, then the destination country is where the market is, that's country Y. So we're putting that back into the starting position. We have a number of different countries we could tax in here. We have the investor in country A, we have a business in country B, and maybe we've got sales in country D. Okay, so where should we tax out of all of those? And to some extent, we might think of country D as being the source, because ultimately that's where the income comes from, that's where the sales are. So, how should we think about that? And which of those would be best? Then I think we need to then say, well, let's think about that across different criteria. What's fair, what's economically efficient, how easy is it to collect? And some of those may give us different answers. And I think we might also even go back to say, well, why do we want to, if we're thinking about taxing corporate profit, why do we want to tax corporate profit at all? And why don't we just tax individuals? Ultimately, the only people that bear the cost of taxation are individuals, not companies. So why bother to tax companies at all? Taxing companies is it's quite a useful way of making companies be tax collectors. They're unpaid tax collectors on behalf of the tax authorities. That's kind of one rationale. But then you can do that in lots of different taxes. And in fact, my income tax is remitted by my employer. It's not remitted by me. I just get the net of tax payment. So we kind of leave that to one side as well. There are a lot of issues here that you've raised. So I think, in terms of, let's start with fairness, which is the fair way of doing that. And I guess it seems to me, each of these countries have some claim on being able to tax the profit or the income which is generated there. The destination country, because that's where, ultimately the sales are made. If there wasn't a market in that country, there would be no income. The country B, where the production takes place, using publicly provided goods and services provided by the government, should make a contribution to those costs. And country A, where the investor is, normally we think in terms of the personal income tax being on a residence basis. So that, that person has received income, lives in country A, should be paying tax on that. So I think the fairness argument doesn't give us a very clear guide as to kind of which of those countries, at least exclusively, should get the revenue. It may suggest that actually all of them should get some part of that revenue. And indeed, that's kind of roughly where we are with the international tax system. There's a kind of mix between, quote, source and residence. But of course, having a mix is complicated in its own way. So if we let's go on to the complexity that creates within the international tax system. The fact that we are trying to tax some income in, let's say, country B, the source country, or country, I think it was country D was the destination country, and country A, we have to kind of distinguish those different forms of income, say, well, which bits of income are we taxing in each of those countries? That's really kind of a bit what the international tax system is trying to do at the moment. And it creates, huge complications. We have to define particular bits of income which we're going to tax in different places. So there's a complexity issue. There's an economic efficiency issue, which is to say, which of those countries is going to be least distortive to free trade and free movement of capital. And that one, I think there's a clearer answer there, where if we just tax where the investor is, and we're not taxing anywhere else, so pure residence base, then that's going to be relatively efficient. It's not going to affect the location of where that investor chooses to make set up the business. And equally, I think if you go to the far end, if you go to country D where the market is, again, that's not going to affect where the location of the business is, because the market is pretty much fixed. It's where the people are. India has a huge market and it's not going to move anywhere. So if we were taxing in the place of the market, again, that would be relatively economically efficient. I think the more economically inefficient way of doing it would be to tax in the source country, where the activity takes place. Anybody who's listening who doesn't know where we tax at the moment, guess where we tax? We tax kind of primarily where that activity takes place, quotes the source country. So I think that does raise a lot of difficult economic inefficiency issues regarding location choices of multinationals. And that creates other problems, which we may talk about later, about tax competition, because then two countries, if I'm an investor and choosing between should I go to this country or that country to locate my business, one of the factors which will determine that will be the tax rates in those countries. And so each of those countries, if they want inward investment, they may reduce their tax rates in order to try and undercut each other to try and get that inward investment. And that's a kind of zero-sum game between countries, which drives down tax rates, which means that governments get less revenue, to some extent to the benefit of the business, because they're paying less tax.
I have a follow-on question. So you spoke about source, or you're suggesting that source-based taxation could be or is more inefficient and can lead to tax competition. But thinking about residence-based systems as well, there could be countries that could design systems where it could allow companies to shift their headquarters and completely change their residence. Even there could be a competition even in terms of what we call CFC regimes.
Yes.
And so what would you say to that?
that's a very fair point, and takes us back to what we mean by residence, I think. So in my kind of simple example, there's just an individual, excuse me, as a rich individual who's kind of investing this money. But if we think of, actually what the individual does is set up a headquarter company, and then the headquarter company has various subsidiaries around the world. You might also think of the headquarter company as being the place of residence. And in that case, then I think you're absolutely right. We can move the headquarter company as easily as we can move the subsidiaries. And so I guess I was really thinking of the headquarter company as just part of the whole activities of the multinational company. So it has all kinds of subsidiaries for production, for finance, for marketing, whatever it may be doing around the world. And headquarters is one of those. So I think that's part of the problem in thinking about these broad terms, residence and source. If we think of the headquarter company as being the place of residence, then yeah, sure, that could move as well. Yeah, I'm thinking, and even the individual could move ultimately. So I mean, it's not that individuals cannot move or will not move. I think the market may be less likely to move than the individual. If I was lucky enough to be a billionaire investor and I was facing high tax rates, maybe I'll go somewhere else, and that's what billionaires might be thinking of doing. So they could be mobile as well. They're probably not as mobile as subsidiaries of multinational companies, which are set up in different places for a number of reasons, but reducing costs, of which one would be taxation. So I'm not sure I've completely answered your question. I've kind of pointed to some of the factors which would kind of relate to that. I guess my own preference, based on the work that I've been doing, is actually to not choose residence or source at all, but actually to use destination. And the point of using destination is primarily to do with that lack of mobility of the market. The billionaire investor might move, but the billion people in India are not going to move, probably because the multinationals that are selling to them would be taxed on that.
So a clarificatory question again, Mike. When we say destination-based tax, is it similar to a source, or would it look a lot like a source-based tax system?
I think it's different from a source-based tax system as most people think about it. So I would think of, you've got where the investor is. You've got where, let's think in simple terms, there's a factory producing something, cars, which are then exported to the third country where the market is. And I think of the source as being where the production takes place, the market being where the sales takes place. That might be the same country in many cases, but it also might be different. So we're basically putting international trade on top of international investment. Yeah.
So that's a very interesting point, and I think that brings to fore the distinction, as you said, within the concept of how you define source.
Yeah.
And that brings me to my follow-up question, which is a little away from this topic, but related, which is on tax incentives.
Right.
Over the last few years, we've seen that tax incentives are looked at in a way as if it is against the principles of international tax, because there's been a race to the bottom. Effective tax rates have declined over the last 3 to 4 decades. And my view is that in the future, we still may need some of these tax incentives, but I want to understand from you on what do you perceive as the future of tax incentives?
Another good question. And I think that's, actually the future in practice depends very much on the way that the global minimum tax, which has now been introduced, will work. But let's take a step back from that first and think about tax incentives generally. So I think there are tax incentives for different reasons. So one reason is, many countries give tax incentives, for example, for research and development.
Yeah.
Okay, so why do they do that? At least in principle, they're doing it because there's positive externalities. It's good. It's good if there's more research and development, and the person doing that research and development is not going to necessarily capture all the benefits from that, because some of it is shared with the general public. So subsidizing that in some way or giving a tax incentive for that is generally thought to be a good idea. Okay, so I think there's a kind of general acceptance that kind of tax incentive is good. I think there may be qualifications, but let's leave that to one side for the moment. A different form of tax incentive is as you were kind of implying, this is part of a tax competition between countries. So on the one hand, if you and I are in different countries and we are both, we're governments competing for inward investment, one way of trying to get that greater investment is, better infrastructure. Another would be to reduce the tax rates. And another would be to keep the tax rate as it is, but give specific incentives for multinationals, even perhaps to do deals with specific multinationals for specific forms of investment. And so those forms of investment are, they're designed to say, come here rather than there. And that's more like a zero-sum game between countries. So I can quite understand that any individual country wants that inward investment and may feel that actually introducing a tax incentive of that form is the best thing that they can do. The equilibrium of that game between many countries all competing for limited amounts of inward investment are that those tax incentives will get bigger and bigger. The benefits are to the multinational companies which are doing that investment. And ultimately, governments lose out because they're not collecting the tax revenue. What we do about that is really very difficult to identify. I think what you really need is it's a bit like collusion in a market. The market here there are kind of government players here who are kind of setting prices for coming into my country. I'll reduce that price to undercut my competitor, which is another country. But ultimately, I've got a lower price, a lower tax rate, or a tax incentive. I think so how could we address that problem? I mean, actually, one way of addressing it is the way that we have addressed it, in a sense, which is, okay, let's all agree on a global minimum tax. So if and it's true, the global minimum tax has been introduced in a kind of patchy way. So it's kind of mostly there in Europe. It's not there in many other important countries like China and India. And it's there, but in a different form in the United States. But suppose we actually did have a minimum tax of 15%, then that limits tax incentives. That limits the extent to which governments can introduce tax incentives. It means they could compete down to 15%, but no further. Then there's a kind of more technical issue, which is, okay, well, within that global minimum tax, actually how far can you include tax incentives within that? And now we're getting into the kind of details of the rules of those who designed the global minimum tax. And there are different ways that different forms of incentives are treated within that structure. And I feel a bit uncomfortable about all of that in a sense, because the whole point of a global minimum tax is to say there's a minimum, and if you allow incentives within that, then we're actually not solving the problem of tax incentives, and we're not solving the problem of tax competition. On the other hand, from an individual perspective, I'd like everybody else to be constrained, but not me. So everybody wants to kind of have those extra incentives, but they don't want anybody else to have them. That would be the best outcome of the game for any individual country. And it's not clear where we go from that, because in principle, countries can do what they want. The way that the global minimum tax works is that if I have lots of incentives and countries don't pay any tax, or are even subsidizing them, then some other country may be taxing their profit instead, which would undermine my incentives. And so I guess that's the way in which the global minimum tax structure is actually trying to combat the use of tax incentives. And it should be. But then let's come back to the beginning of my answer, which is to say, okay, that seems reasonable for these kind of zero-sum game incentives. It's less reasonable for incentives for research and development. And actually, one of the countries which complained most about the treatment of incentives was the United States, which has generous research and development tax credits, which it didn't want to have to get rid of under the global minimum tax.
Quite interesting that you raised the point about R&D incentives, and I wanted to ask if, other than R&D, you thought there were tax incentives that work and could continue. And I ask this because there is a focus back on competitiveness, especially in the EU. And there may be industries that are aligned with priorities going forward, including the focus on energy transition. So do you think there are some kinds of incentive that work better?
Better than others in particular circumstances?
Yes.
Yes, I mean, I think there's always a big debate about what we're thinking here is more like either industrial policy or like climate change policy. So we're trying to encourage some forms of energy rather than others. Yes, I mean, I think tax has always been thought to be a kind of way that you could address those kind of things. So it is a bit more like the R&D tax credit in the sense that, we think that this is a useful tool in the armory for combating climate change. And so what's the question? Do you want to think about that in the context of tax competition or more generally?
More generally, I sort of want to reflect a little bit on which tax incentives can we continue to prioritize or assume that they work in certain circumstances, because the discussion is almost as if tax incentives are wasteful. And so therefore we need to look at a system which is cleaner. But do you imagine that there are some tax incentives that can still serve the purpose of shifting activities to sectors that may be priorities?
Yeah, I do think that, yes. And I think, and there are different tools which governments can use to do that. I mean, one might be a tax incentive, another might be a regulation. We just, we ban some things or we limit the quantity of some things. So we could limit the quantity of carbon emissions, have some tradable permits for who can make carbon emissions, for example. And that way you can kind of fix the quantity. So the alternative way is doing it through the tax system. I think that's all fine. Those are kind of things which governments ought to be doing, and that's all part of the big picture is a kind of externalities there. This is something which is kind of helping society. This is not the zero-sum game kind of tax incentives that we were talking about as part of the tax competition game. And I think those are still very valid. I think they're very difficult to implement successfully. If I'm a government and I was thinking, what I really want to do is kind of incentivize solar power, for example. How am I going to do it? Who am I going to offer this to? How big are the incentives going to be? What do I think the response of business is going to be, or actually new businesses, because I want new businesses to start up. It's very difficult for the government to know exactly how big to make those incentives to get what they think is the appropriate response. So it's not easy to do. It's not like you can just kind of say, okay, incentive now we've got plenty of solar power. And I guess there's going to be trial and error there, just as there is for businesses in setting prices and kind of trying to figure out how much of something they can sell. So the government has to kind of set rates of incentives for these kind of activities and hope that it gets the right kind of response. And if it doesn't, then kind of modify them.
Yeah, I think part of the problem is a systematic assessment of impact that these incentives have. And I've seen that you previously, I think, looked at R&D incentives in the UK, which seem to have worked. Yeah, indeed. Yeah. So I think we did find that R&D incentives created more R&D. That's good. I mean, an interesting question is a pound spent on R&D tax incentives, does that create, how much extra R&D does that create? If it creates less than a pound, then you might think, well, the government should just do it itself. I mean, we did find that it was more than a pound, but, not that much more than a pound. So, Mike, you raised a very relevant point again on the fact that the tax system could work either in terms of providing incentives, or it could also disincentivize certain activities. So, for example, you gave the example of carbon taxes, and I want to go step back a little and ask you a question on tax as a regulatory measure. So very often tax is thought of as a sand in the wheel. So one of the proposals that you thought about very long ago and it never came to fruition is the financial transactions tax. And then there are a lot of suggestions on carbon taxes as a way of reducing emissions. And it's not that all countries have been willing to implement it. So my question to you is that, do you think taxes work as a good regulatory measure, or should we just leave them to raise revenues?
Well, I guess their primary purpose is to raise revenue. Governments need the money. Can they affect behaviour? Certainly. A big part of what economists do thinking about taxes is what is the effect on behaviour, and some of that may be positive, some of it may be negative, but generally we think of taxes. Taxes on business, for example, means that actually part of the return to an investment is going to be captured by the government. I'll do less investment because some of it the government is taking some. So that's a response. We think of that as being a negative response. Certainly, we can think of cases where we deliberately introduce the tax in order to get what we think would be a better outcome, as in with carbon emissions. So, and we have taxes on fizzy drinks because we don't want kids to consume lots of sugary drinks. That's bad for them. We have taxes on tobacco. That's bad for people. All of those kind of things. I think are generally accepted. I don't know. I guess most countries have those kinds of taxes. And actually, it tends to be, we tend to put taxes on things which are most addictive, for like cigarettes. So the largest part of the cost of a packet of cigarettes, or the price, is actually the tax. But actually, it's a very inelastic demand. People will stop smoking a bit, but they won't give up entirely. I think having said that, again, I come back to this is quite difficult to figure out what to do, and in which circumstances there's a good case. I think tax on tobacco is generally accepted, carbon tax is generally accepted, financial transactions tax, which you mentioned, I think that's much less clear in my mind as to what the point of that is and what's what the outcomes will be. I think the European Union did advocate a financial transactions tax, and it kind of went from saying this is going to be like a tiny tax on every transaction. The amount per transaction is like almost zero, but actually because there's zillions of transactions, this adds up to a very large number. But I think they wanted to make the case that because the kind of tax per transaction is very small, it's not really going to have a big effect, and this is a way of collecting a lot of money. Maybe it will slow down trading in the financial markets as well. But it's not clear to me what the problem of trading in financial markets is that we're being addressed here. I think actually the motivation for the financial transactions tax was to raise a lot of money in a way which nobody would kind of feel that it was a tax on them. It's not like saying we're going to increase your income tax and you feel aggrieved. We're just going to have a tiny little tax on financial transactions. Nobody's going to notice, but it's going to raise huge amounts of money. So somebody's got to be worse off if it's going to raise huge amounts of money. And it's pretty hard to figure out who's going to be worse off. Maybe it's kind of rich capitalists who are kind of doing lots of trading. Maybe it will get passed in prices such that actually, normal people will be hit by this tax as well. And I think there was not really enough consideration of who's going to be worse off because of the tax, whether there'll be any beneficial effects of this tax or not. So I think that's a good example of governments can do sensible things with taxation to try and change behaviour, but in my view, they can also do, things which are less than sensible to try and change behaviour, or because really what they want is more revenue, and they're dressing this up as a kind of something which is good for society.
And that's a very interesting point you make, because India has a securities transaction tax.
It does, right. I'm sorry, I'm not fully aware of the Indian tax system.
So it's levied on transactions, right? And it was introduced in place of capital gains tax on equity initially. So to say that, we have this instead of having capital gains tax on equity transactions.
Right.
The capital gains tax made its way back, but STT still remains because it's a good revenue raising mechanism. And the evidence to the fact that if you raise STT, the transactions, especially in the futures and options market, sort of subside, that the evidence is not quite clear on that.
Right.
And so that sort of corroborates what you're explaining on the FTT as well. In the EU, it might just be a revenue raising mechanism. But on the sin goods, Mike, if I can ask you a question, which is that taxes could be raised, but you're saying that the demand is inelastic.
On some goods, typically on the ones we want people to stop buying. Yeah.
But would you imagine that there are other factors that could drive this change alongside taxes? So just for a moment, just imagining that if healthcare was more costly in the UK,
Yes.
then you would have an individual making a decision that, well, it's not just taxes, but if I were to suffer the consequences of consuming a sin good, then accessing the healthcare is a lot costlier, and so therefore I
Yes.
stop for that reason and not taxes.
Yes. So what's the question?
So my question is that it's not really taxes which is driving behavior. It could be other factors within the public finance system that
sure.
are actually.
Absolutely, yeah. So it's not only taxes. I mean, I think taxes can have some effect. Other things are going to have an effect as well. I mean, actually, if we think about smoking, for example, and yes, it's certainly true that in the UK there's free healthcare. You don't get turned away because your disease was caused by you excessively smoking. I mean, you could introduce a regulation saying if it's caused by smoking, you have to pay for the healthcare yourself. Don't think that would be very popular, but you could think about that. I mean, the thing which was actually really quite influential in reducing smoking in the UK, I think, was actually just banning smoking in public places. And first of all, in pubs and bars and restaurants. So, actually, and this was under the Blair government 25 years ago, 25 years ago, probably. I can't remember exactly when it was. But before that, you go into a bar, it will be full of smoke. And now you go into a bar and there's no smoke there at all. But there's plenty of people drinking, possibly drinking too much. So we also have taxes on alcohol to prevent that. But the smoking thing, I think, that was a non-tax regulation, which was hugely effective, I think. Yeah.
Thank you, Mike. So I think what I can conclude is that taxes should primarily be for revenue raising, and then think of other goals such as regulation.
Yes, I think that's fair. I think, ultimately governments need a lot of money to pay for all the things that we're talking about, like healthcare and defence now and everything.
Yeah.
That's the starting point. But I think there are valid other uses of taxes, and also invalid other uses of taxes.
Thank you so much, Mike, for your time.
It's been a pleasure. Thank you.
Thank you.